Okay, so we're starting the recording. I would like to welcome you all to the first session of the practical training workshop for the cash basis IPSAS. This is the first of the 10 sessions that you will be attending in the next few weeks. I'll be giving you an overview of what is in store for us today before I turn you over to the presenter. Hold on, I have to figure out how to. There you go, there's the overview. So first, we'll do the introduction, and then I'll give you the overview of the cash IPSAS training module, and then we'll go ahead with the workshop. And after the workshop, we can discuss some admin issues, such as scheduling the rest of the workshop sessions, and if there's any IT issues that has been encountered by the participants. We can discuss that to make the rest of to improve the rest of the sessions throughout. So just to give you an overview of the, sorry, there's a lot more people entering. I have to let them in through the lobby. Hold on. There. Okay. So among the activities for the PFM training program is the practical workshops to support financial management processes within the government of Somaliland. So among the practical workshops, there's going to be 3 modules to be covered. The first one, which is what we're doing now, is the cash basis IPSAS. The second one is on budget preparation, and the third one will be on budget monitoring. The cash basis IPSAS comprises of 10 topics, as I'm showing you on the screen. Each topic will be 1 session, and each will be delivered within 3 hours with a break in between. You will be discussing with the presenter later when the breaks will be throughout the 3-hour sessions. So this is the session. So this is session 1, scope of IPSAS. Sean will be providing you with the subtopics for the first session, and then the rest of the sessions are shown on screen. So without further ado, I'll present the presenter for today is Sean Brown. He has been teaching financial and non-financial related subjects for 20 years as an associate trainer worldwide in both public and private sectors. His specialization is finance, management, audit, governance, risks, and ethics. He teaches across a wide range of subjects and have experience of delivering training in and online and classroom-based environment in both local and international delegates. So let's welcome Sean, and he can start the presentation. Thanks, Sean.
Thank you, Abby. And first of all, hi everybody, and welcome to our class together. Can I ask you first of all, just so we all know what we're doing, can you please all turn your cameras on so I can see you all? Be lovely to see you all if I can. All put your cameras on so I can see your happy smiley faces. That's it. Abdiram, I can see you. Well done. That's one. Give me a big wave. That's it. That's it. Lovely. Good man. Well done. Thank you. All turn your cameras on for me so I can see you. So I can see your lovely smiley faces. I can see Abby. Hi, Abby.
Hi, I'm here. I was the one talking.
That's lovely. Any more coming through with the cameras? Yes, it. Let me see your faces. There we go. All turn your cameras on so I can have you all on the screen to see all your faces, and we can. It's more personal then, isn't it? That's lovely. Hi, Fazil. Welcome. Nice to see you.
Hi.
Lovely. That's good.
So
I can see Fazil. I can see Abdiram. Yeah. Abdi Aziz, is your camera on? Put your camera on for me. Mohammed, well done. I can see you. Good man. Lovely. Nice to see you. Well done. Fantastic. All looking good. A few more coming through with cameras. Abdiram, you keep walking backwards and forwards. Have you got a bad leg?
Where did you go?
Okay, any more cameras coming on? Okay. Right, now, just before we start then, so just by way of introduction, I'm going to go and share the screen and link up with you with my PowerPoint slides. And we'll be flitting backwards and forwards between the PowerPoint slides and also the main notes I've got for you as well to like a scribble pad. Okay, now, first of all, although I do lots of online training, it's obviously, as you can appreciate, it takes a lot of practice to get this right. So apologies in advance if I lose things from time to time. I will do my utmost to, and Abby's watching me as well, so she'll keep an eye on things.
Yeah.
So I'm now going to share, and we're going to share our...
Oh, Sean, before we start, maybe we can agree on what time we should have a break.
Yeah, I'm going to use that as part of my open slide
sorry.
here. Yeah, that's okay. Okay, so first of all then, obviously this is, as Abby mentioned earlier on, the course we're doing, your education and training, PFM, about the IPSAS use of cash basis of accounting. So just by way of introduction then, this is me, Sean Brown. My family come from Ireland, a place called Cork in Ireland, a place called Blarney. There's a big castle there with a famous stone. And if you kiss the stone, Abby, it brings you luck, doesn't it?
Yes.
Have you ever kissed a stone, Abby?
No, I haven't. And I'm
No.
here in Ireland. I haven't been there.
So if you ever go to famous castle called Blarney Castle, you kiss a stone and it brings you luck for all your life. That's wonderful. I'm a qualified accountant, and I've been qualified, say, for many, many years. And like you guys, I worked in government, I've worked in finance, in government and public sector and private sector. So a wide range of experience, and also appreciating what you're going through. You can see there that it says NHS, local authority, Ford Motor Company, large audit firm. These are places I've worked before I became an associate trainer. And you can see based on that it's a wide variety, both in public and private sectors. And the accounting standards, whether it's public or private, overlap into both. So I can bring lots of thoughts and ideas into our conversations together to help you understand the bigger picture. I've got 3 children, married, 3 children, and we've got a cat called Marley, a dog called Daisy, and we've got 3 guinea pigs. So no doubt we might have a little test later on. I'll test you on the names of my pets, okay, to see how you're getting on. Okay, so there's a bit about me. So just before we go any further with the training then, what Abby and I would like to do is find out what time is best for you guys for your prayers. So I know we're starting now, say 4:15. So 5:15 is an hour. How about maybe 5:30, something like that? Would that be reasonable for your prayers? 5:30? Can you all say unmute your microphones? Yes or no?
I think 5:30 is fine.
5:30 sounds fine. Good. Well done. Everybody else okay with that? Sounds good? 5:30 sounds fine. Okay. Yeah. Well done. Brilliant. Abby, would you kindly put a reminder in for 5:30 so we know when to stop for prayers? Lovely. Thank you.
All right. We'll do that.
Thank you very much indeed.
Okay.
I'm sorry, I can't quite reach it. Can we have a system? What we'll do, if we all put our cameras on mute, and then we'll have a raise your hands issue, Sheree, if you need to speak. That'd be probably the best thing to do, so we don't all speak at the same time. So is that okay, everybody? We do that. Put our microphones on mute. Keep your cameras running, and then I can then see you. If you've got queries, put your hand up and say, "Oi, got a query." Okay. Everyone okay with that? Right. Okay then. So. Okay, I can't quite hear what you're saying. If you've got a query, can you just kindly unmute you, put your hand up so I can see you've got a query? Put your phones on, put your cameras on. What? Put your phones on. Put your cameras on.
Sean, there's if they look at their at the screen, you know, there's some buttons, icons there. If they have a question, they can raise their hand. There's a hand icon.
Yeah, I see that.
They can press it and it will show if there's a question.
That's fine. Yeah. Brilliant. Thank you very much indeed. Thank you. Okay, so let's move on then just again from a starting perspective. Let's go on to our slides and have a look at our next section, and we can start moving forward. Okay. Now, the first thing we need to do then is consider the objective of the session. And what we're going to do throughout our 10 sessions together is develop your understanding of the IPSAS standard. That's really, really important over the time together. And appreciate the difference, and this is the big one, between cash and accruals accounting. So we're going to go into a lot of detail about this throughout the 10 sessions together, because ultimately you're starting now with the cash accounting, and over time you'll be moving towards the accruals accounting. Now, many years ago, when I worked in the NHS, we were using cash accounting, so I was involved in the transfer between cash and accruals accounting. Now, you might be sitting there thinking, what's that all about? What does it mean? Obviously, I'll go through that in detail and explain it. We're going to talk about the awareness of financial statements presentation, like the formats and the layouts using the cash basis. And as Abby mentioned earlier, other parts of this syllabus involve budgets, budget establishment, budget monitoring, which we'll come on to later. And then towards the end, working towards the big transition from cash to accruals basis. So I hope that all makes sense to you, the objective of the sessions, what we're going to be doing. And as always, we said, any questions you've got throughout the sessions, press your raise hands button, and then we'll keep an eye on those buttons, making sure I answer your questions as we go along. Okay, good stuff. So let's move on to our Zoom slideshow. Everything revolves around this thing called an accounting standard, So the IPSAS is an accounting standard. Now, the question is then, who, first of all, issues these accounting standards? Is an organization called IFAC. Now, we'll come to IFAC in a bit more detail in a moment, but I want you to imagine there's this international body, and it's made up of accountancy bodies, okay? There's, believe it or not, 179 of them, and they all got together, had a nice cup of tea and a few biscuits, and they all said, what we need to do is talk about a situation where we're going to move forward and get people doing the same things all around the world. So the idea of an accounting standard, and it's the word standard. So if we all had the same haircut, if we all wore the same shirt, it'll be a standard. So clearly we're following an accounting standard. And as you can see on the screen there, promoting standardization, we all do the same thing. And that also means that all the financial statements around the world, so for example, in every local government, central government, Ministry of Finance, whatever it may be, they can all be compared by different countries around the world. Encourages harmonization. Again, we want everyone to be doing the same thing, so it makes it nicer to begin getting on together, whether it's Somaliland, whether it's Somalia, the accounts being very similar together, again, being able to follow them and making sure we can compare them to see how different countries are doing. I do a lot of work with Ethiopia, and again, it's interesting to see how they're moving forward now with the cash system towards the accrual system, which I'll go on in a bit more detail later. Okay, and we mentioned there that accounting standards apply to both public and private sectors. So when I worked in Ford Motor Company, we had specific standards for the cars. And if you've got cars in the Ministry of Finance, you'd follow later on the same standards. So whether they apply to public or private, doesn't matter. The standards remain the same. Okay, so the whole thing about an accounting standard is trying to get everyone to do the same thing. Now then, IPSAS standard. Who actually issues the standard? Well, like we said in the previous one, an accounting standard issued by IFAC. So here we can see IFAC publishes the IPSAS standard. So who is IFAC? This International Federation of Accountants. So again, accountants are taking over the world. Yep, okay, IFAC, International Federation of Accountants. Can you see there the makeup of those bodies? I don't know if you've heard of some of these names before, but for example, in Somaliland, you've got many of your colleagues in the Ministry of Finance who are studying for the CIPFA. And at the bottom of the screen, can you see that? The Chartered Institute of Public Finance and Accountants. So that's what it stands for. So the Public Finance of Accountants, It's where if you are a specialist working on, let's say, Ministry of Finance or the National Health Service here in the UK, then you can actually see it's beneficial to have that qualification linked to public finance. You may have heard of ACCA, the Association of Chartered Certified Accountants. That's really, really big worldwide. And you can do ACCA in any organisation, whether it's private or public. But like I said, CIPFA is more geared towards public. But the important thing to appreciate is that these 179 member bodies around the world, of which there's a few on your screen, are all members of IFAC. So when IFAC issues a standard, everybody working for those bodies as a member of those bodies will all follow that standard. And that's why it feeds down from the top down to the individuals working in that organization. Okay, does that all make sense? Abby, I haven't got the hand on my screen. I can see. Can you keep an eye on it for me, please? If anyone's asking questions.
Yes, I'll have a look. Yeah.
Thank you. Okay, so it's really, really important we understand this organization called IFAC. It's really important we understand what they do and how they work. So what we've got here is basically the mission of IFAC. Now, I don't need to read it to you word perfect. You can see what it says on the screen, but I want to pick up on some of the key points here. Remember, IFAC is made up of all these different accountancy bodies, and we're going to serve the public interest. So you think about it. In the Ministry of Finance in Somaliland, you are looking after the public purse. So people are paying their taxes, the VAT, you're collecting that money in, and then you're managing that money on behalf of the government. So that then pays for the roads to be maintained, the rubbish to be collected, all these sorts of things that you've got to pay out for. But can you see the important thing here? You're serving the public interest. So IFAC develops the standard, passes it down to you and I. We all follow it because ultimately we're serving the public interest. It does develop the accountancy profession, so we're all building our reputations and actually doing things better. Just while we're here, did you ever hear about an organisation called Enron? E-N-R-O-N, Enron. Enron were this really big public sector company, public utility company, and Arthur Andersen were their auditors. And Arthur Andersen, unfortunately, got into some trouble because they were basically working too closely with the directors of Enron. As such, when Enron said, we don't want to follow that particular standard, Arthur Andersen said, oh, okay, then we'll ignore it. Well, you can't do that. So over time, what happened, Enron, who was making loads of money, suddenly collapsed. And Arthur Andersen, one of the big audit firms, they also collapsed because of people, their reputation was tarnished as a result of the bad work they were doing. So that's why it's really, really important we appreciate recognizing, for example, revenue, how we record revenue, how we record expenses is so important. And the IFAC sends us down these standards and again develops our profession. So we have no naughty firms such as Arthur Andersen. Again, all self-explanatory there, supporting the development of high quality international standards. Remember, they spend a lot of time researching these standards. What do we need out of these standards? Okay, what do you want to get out of them? And how does it impact on the public interest? And that is why, most importantly, again, they're high quality. So again, we are encouraged, we are following these standards, we promote them, we adopt them. And in the financial statements, we say, okay, let's follow the standard as we should do, because IFAC expects us to. And don't forget, the more we follow the standards, the more professional we are being. Okay. And IFAC are also quite well known for speaking out on public interest issues. So, for example, if people said, look, we understand that the Ministry of Finance will produce these financial statements, but when they do so, are they really made up correctly? So again, IFAC can speak up on behalf of the Somaliland government and say, yes, they're following our standard, so therefore they are producing them correctly. Okay, that's really important to do. Now, just before we move on to the next slides, I just want to draw you a little diagram because I've been using the words financial statements here. So let me just click on my, bear with me. Go to share screen. Here we are. Okay, so hopefully you can now see my Windows Journal notes. I'm going to do a bit of scribbling on here to help you understand it better. So PFM, your IPSAS course we're doing here. So I've been using the word financial statements. Now, if you've got pen and paper with you on your desk, feel free to copy this down. And as Abby said earlier, it is being recorded, and I'll save this and email it to Abby to send on to you. Okay. So when we talk about financial statements, we're basically talking about three main financial statements. I'm going to use the official terms, and then we can adopt them to your own terms as we go along. Okay. So basically, we have the income statement. We have the statement of financial position. So I made it writing a bit tidier. My apologies. My dreadful handwriting there. Okay, statement of financial position and a cash flow statement. Now remember, these three terms I'm using, these are the standard international terms issued by IFAC. Slightly different, I know, when you're using the cash-based system, but this is what the end result's going to be that we'll be trying to get to. So the income statement will show all the income and all the expenditure. Okay, it's as simple as that. And then the difference will be, okay, a surplus or a deficit. Okay, so you see the income statement, you've got the income minus the expenditure, give you a surplus or a deficit, also known as a profit or a loss. So the income statement is one of the main financial statements. Now, at the moment, your income statement is produced on the cash basis. And that's what we're discussing here about your standard. When cash is received and when cash is paid. But the actual, what we're working towards with the IPSAS standard is producing it on the accruals basis. On the accruals basis. And this is where I referred to in my earlier presentation when I spoke about the cash basis versus the accruals basis. So the cash basis is an income statement with the income and the expenditure when the cash is received and when the cash is paid out. On the accruals basis, it's the same thing, except I'll show you a bit later how it differs from the cash basis. Okay. The statement of financial position, also known as a balance sheet, if you've heard of that before, a balance sheet, and it's basically a statement of the assets and liabilities. A statement of all the assets and liabilities. Now, when you're using the cash basis, it's quite easy to say, look, well, you have no liabilities because we pay out cash. Whereas when you're on the accruals basis, you'll actually be showing the amount you owe if it hasn't yet been paid. Okay, and that's one of the important things about IFAC, what they be wanting you to adopt in the future, appreciating the difference between the cash and the accruals basis and the kind of financial statements you'll be producing as you go along. Now, the cash flow statement is exactly what it says. It records the movement of cash. It records the movement of cash. And the whole idea behind that is you can see the impact on this will reconcile back with your bank account. So you can actually see the cash inflows as they fly in and the cash outflows as the cash goes out. Okay, but ultimately you'll be moving from where you are at the moment to producing these statements here. Okay, and that's how your ultimate standards will follow, adopting these. So by understanding how the cash IPSAS works at the moment, that'll make it easy for you to understand when you're using the accruals IPSAS later on. Okay, so I hope it gives you an overview of the type of financial statements that I've been referring to, the three main financial statements that you will be moving towards as part of the accruals accounting later on. Okay, we'll just go back now to our slides. And we'll share our slides over here now. Okay. Don't forget, like we said, any questions, raise your hand. Anything you're not quite sure about that I'm mentioning. So this is what we mentioned earlier about IFAC, the IFAC mission in relation to strengthening the accounting profession. Because all around the world, there are millions and millions of accountants all following the IFAC standards. Okay, good. Now then, the IPSAS standard. This is really, really important because this is based on your cash IPSAS standard as at now. Okay, we have, first of all, two parts. The first part, part one, is mandatory, must be followed. It sets out the requirements applicable to all public sector entities. So in other words, everybody must follow this standard who's in the public sector. It goes into detail about the cash basis of accounting. It talks about the different type of cash inflows and cash outflows and what it really means related to cash. It talks about disclosure requirements. Now, when I mentioned in that drawing about the financial statements, when you produce these financial statements in any format, whether it's cash or accruals, one of the key things you've got to remember is that the information in the accounts as numbers is meaningless unless you've got supporting notes that go with it. So if I said to you, I've generated 100 million revenue, you're going to say to me, that sounds good. What is it made up of? So what you now need to do is go to the notes to the accounts and actually see, oh, right, okay, well, we've got VAT, we've got taxes, we've got other forms of income, some interest and so forth. So you can see how the money comes in and how it's been accounted for. So that's the important thing about the financial statements to remember, is that in part one, certain things must be shown. They will be required to show these. And in part two, it's not mandatory. So in part one, we're talking here what you must have in the financial statements, like the notes and the disclosures. But in part two, what this does, it says, we encourage extra information. Okay, see the word there, second blob down, identifies additional accounting policies and disclosures public sector bodies are encouraged to adopt. So everything you do in part one of the standard must be adopted, but part two can be adopted. Okay, and the idea there is to basically volunteer more information if you can. So for example, if you're being assisted by third parties, and let's say, for example, the World Health Organization gives you a grant, that third party disclosure can be made through the part two. Okay, you know, ideally you really want to make the disclosure, because don't forget, everything that's included in those accounts is going to be reviewed, it's going to be compared with other countries, other ministries, so it's good to have everything in it. But you don't have to do it in part two, but it is good practice to do it. So when IFAC say it's not mandatory, but they encourage it, that means it's a bit like you go home and you say to your mum, right, mum, I know you want me to tidy my bedroom. I know you said I've got to do it, but do I have to really make it completely tidy? So your mum encourages you to make your room tidy. And if you don't get any dinner. So there you go. You'll be in trouble. Okay, so from that perspective, then it does help the accountability and decision-making purposes in relation to the whole financial statements. Remember, I know I keep going on about this, but the financial statements must be standardized. They must be shared. They must be easy to follow. By having more and more information per the IPSAS in there, that's what's going to happen. That's what you'll be able to do. Because remember, ultimately, that's what IFAC wants you to do. Okay? The last one there on our list says it supports the transition to accruals accounting and adoption of IPSAS accruals basis. Now, at the moment, you are following the cash basis. We know that. But over time, IFAC want you to adopt the accruals basis. Remember what I said earlier on, the NHS, they used to have the cash basis only, and over time, they became the accruals basis. Same with the Ministry of Defence, same with all the other public bodies in the UK. They were once all cash accounting only. So it's quite a transformation. When all around the world, different countries, like say Ethiopia, are moving towards the accruals basis now, because again of harmonisation, standardisation. So fewer countries around the world at the moment are using cash accounting, because eventually everybody will be on the accruals accounting. And that's why I have to keep emphasising this, because over time we will be doing this together. Okay. Now then, IPSAS, when was it issued? Well, originally in January 2003. So originally, basically, there was very little guidance on what you had to do. Very little guidance. So what it came down to was identifying, well, how can we actually make the accounts more useful? How can we make the accounts more comparable? And the problem was every country was doing their own thing. Same as the UK, the NHS was doing their own thing. The Ministry of Defence was doing their own thing. There was no real guidance to say, this is what you've got to do. So in 2003, then, IPSAS issued this standard. And it's being updated. As you go along, it gets updated. So you see 2006 and 2007. So what happened in 2006? Well, they included the presentation of budgetary information. Now, before that, it wasn't needed. I mean, why would you need to show a budget? Well, it comes down to what you plan to actually receive and what you plan to spend. And that's the important thing in relation to the budget part of here. And 2007 encouraged disclosure of any external assistance. Now, we mentioned this earlier on, like the World Health Organization, who gave you assistance. So again, you were encouraged. But look at those two words, everyone. In 2006, required, part 1, remember? In 2007, encouraged, part 2, not mandatory. But part 1, if it's required, is mandatory. If it's encouraged, is part 2. So the more you look at your financial statements, the more you'll see what's included and what is not included. And you can then see, actually, with a bit more information, that will make much more sense to help explain what's going on. For example, where did that money come from? Did it come from the World Health Organization or from the US, for example? Let's have a look at that. I mean, Coca-Cola, as we know, has built a big bottling factory in Somaliland. Again, that's created jobs, that's created prosperity. So from that, we can see that the external assistance might be in the form of local grants from Coca-Cola to help small suppliers supply Coca-Cola with the raw materials that they need. Okay? But the big thing happened in 2017. The revised cash basis was issued in 2017. So this is the big one that we're using now. And this is why it's important that you are updated on this new standard. So what does the standard require now? Well, first of all, a revised standard requires consolidated financial statements. So what do I mean by that? I'll explain that in more detail in a moment. The standard requires disclosure of external assistance. So now you've got part 1 for the disclosure, whereas before, don't forget, it was part 2. But now it's part 1 mandatory. The revised standard encourages any third-party payments. So again, anything came in like that, you can actually show it. It's encouraged to show it in part 2. So this is what the standard has done, and it's given us revised updates to help us appreciate what's actually going on. Okay, so we're happy on the organization called IFAC. IFAC have issued the IPSAS, IPSAS. They did so in 2003, updated 2006, 2007. And remember, it was part 1 and part 2. Part 1, compulsory. Part 2, encouragement. But 2017 came along and said, right, okay, we've got to standardize everything. We've got to harmonize everything. Let's bring everything together and make sure it's all up to date. Because remember, the whole purpose of this is standardization, harmonization by all of these accounting people all around the world, because we're all members of IFAC. Okay, so you can see it's like top down, can't you? That's the importance of it. So I'm going to flick now to my scribble screen and just talk about the words there, consolidated financial statements, just to help you understand it a bit better. Okay, so the word we used there was consolidated financial statements. Consolidated financial statements. Now, I want you to imagine that here we have a company called A. Let's call it A PLC, public company. A owns a company called B Limited. So let's say that A PLC is based in Somaliland and B is based in Ethiopia. So you can see straight away that A is a parent of B. Now, in addition to that, B owns a company called C Limited. Again, and C Limited might be in the UK. Okay, so you've got an idea of, whereas having one company on its own, you've now got 3 companies all owned by A. Now, what we have to do, we have to produce, first of all, the financial statements for each individual company. So there's going to be financial statements for A, financial statements for B, and then financial statements for C. However, in addition, there's also going to be one more set of financial statements called consolidated financial statements. And these are referred to as group accounts. You may have heard that term somewhere, group accounts, group financial statements. So ultimately, we've got a whole situation here where you've got A owns B and A owns C. And individually, they'll produce their financial statements. We know that. Plus, they'll also produce the consolidated financial statements. And all it basically means is that you add together number 1, number 2, and number 3 financial statements into number 4 financial statements. There's a few twists and a few turns here and there. So, for example, if B owes A any money or A owes B any money, we take those out because they're intercompany. But ultimately, the consolidated financial statements are based on 3 companies, company 1, company 2, company 3, and they're all part of the same group. That's why they have to produce these group accounts. So think about, like Coca-Cola. Coca-Cola will have lots of different companies that it owns. So they're all going to produce their own financial statements. And again, all together, they'll produce the group accounts. And that shows all the companies in the group. And these companies in the group are known as components. You may have also heard of the word subsidiary. Okay, components or subsidiary. And that's where the term consolidated financial statements come in. So this is quite big now for the 2017 IPSAS standard, in that even on a cash basis, this is what's expected: consolidated financial statements. Okay, where the ministry is consolidating all the other components within the organization. Okay, does that make sense? Do you have any questions? Please, again, raise your hand. I'll now flip back to our PowerPoint slides. I'm slowly getting the hang of this, Abby.
Good, good.
Okay, so there we had when was the IPSAS issued, and like we said, very, very important, the last three blobs there show revised standard requires consolidated financial statements, as we saw. The revised standard requires disclosure of any external assistance. Notice I said the word requires, therefore part 1. And the last one there says encourages any third-party payments you may have received, and that will go in there in part 2. Okay, so maybe like a donation or something like that you might have received, that will go in part 2. Okay, I hope that all makes sense. So question is then, it started in 2003, updated 2006, updated 2007, and the big update was 2017. So the question is, why? What was the main purpose of the updated standard? Why was it produced? Why was it updated? Well, we can see here, look, to clarify the role, and this is really, really important, everybody, to clarify the role that the IPSAS standard for cash is a pathway to adopt future accruals. So in other words, it came out in 2003 to give you guidance on the cash accounting. It's been updated 2006, updated 2007, part 1, part 2, and now you're moving towards future accruals accounting. And that's what the update in 2017 is all about. It's going to get everybody ready, moving towards eventually the accruals accounting. So the objectives of financial reporting, this is where you present your financial statements, can be best achieved. I'll show you an example shortly of that. But they really want you to do accruals accounting because all around the world, the majority of public sector and the majority of private companies are all using accruals accounting. So it makes it, remember, harmonization, standardization. So imagine the Ministry of Finance in Somaliland could actually get a copy of the Ministry of Finance accounts in Ethiopia, and you'll be able to compare them. They'll be very, very similar. But if the Ministry of Ethiopia is using the accruals method and the Ministry of Finance in Somaliland is using the cash method, your figures will differ. And you won't be able to say, well, why is that figure like that and why is our figure like that? Because it'll make it very, very different and therefore very hard for you to understand where their figures are coming from. Okay, which is why eventually, Somaliland would also be based on the accruals concept. IPSAS cash-based standard recognizes that accruals accounting is not possible yet in all jurisdictions, and that's a reality. We know at the moment that Somaliland needs to develop a bit further in terms of the accounting process, and eventually you'll all be following the accruals concept, like other countries around the world, and like we said earlier on, easily to compare your accounts to theirs. Okay, so therefore, as they've called it, a transitionary process may be necessary. And this is what many, many countries have adopted, a kind of a piecemeal approach to moving from cash to the actual accruals. So it's a slow process, but eventually people are getting there over a few years. Okay. So before we go any further, do we understand, first of all, the IPSAS was based on, is a standard cash-based established by IFAC. IFAC want harmonization and standardization all over the world. To do that, everybody should be following the same standards, but unfortunately, in certain jurisdictions, cash-based is still being used. So the IPSAS issued in 2017 tells us what we should be doing moving forward, getting ready for the accruals-based standards. But before we come to that, let's stay with cash based on the 2017 IPSAS. Let's look at some of these names, shall we? Because this is the kind of wording that we're going to be using. First of all, then, cash. So what is cash? Well, cash in your pocket is cash. Now, the word cash in hand in an organization doesn't mean cash physically in your pocket. Imagine you've got cash in a petty cash tin. Do many of you run a petty cash system where you might have, for example, some cash in a tin, special controls on the tin so it can't be stolen, and then if people need some, for example, some milk or some tea or some coffee, you'll give them some cash to go and get some from the local shop. That's what I mean by cash in hand. Then they talk about deposits. Now, if you can imagine you've got the main current account and the main deposit account, then the main deposit account will be where you're holding cash to use for a rainy day, like a savings account, basically. Okay, like a big savings account. That's what it's for. And then, of course, the cash and cash equivalents. And if you just go down, please, to the third blob, you can see there what we mean by cash equivalents. Short-term, highly liquid investments. More terminology here. Short-term, highly liquid investments that are readily convertible to cash and they're low risk. So anything you might have, for example, of a speculative nature, but a very low risk, so you might be investing in bonds, that type of thing, on stock market, the bonds, but of course low risk, so you're guaranteed a return and you're almost guaranteed not to lose your money. So that could be argued to be cash equivalent. So I'm going to flip back to the drawing screen to explain a couple of terms here in a bit more detail. Okay, so we use the word liquidity. Now, the word liquidity basically means, imagine water. Water is liquid, and you can get your hands on water fairly easily, okay? So, can obtain easily. Either from the tap or from a bottle, whatever it might be, water can be obtained easily. And that's what we refer to in terms of liquidity. So how quickly can we turn investments into cash? Okay, how quickly can we turn investments into cash? Now let's do a couple of examples to show you what I mean by that. I want you to imagine that you have a shop, and in your shop you have lots and lots of maybe fruit and vegetables. Okay, fruit and vegetables. And every organization has what we call a year end. And it's normally, let's say, 31st of December 19. That was the year end. 12 months worth of work in the shop. You now come to your year end. And throughout the year, you have actually bought, again, using cash accounting, you bought for cash lots and lots of fruit and vegetables. And of course, you've sold them, again, for cash, all the vegetables. So let's say that you bought I'm going to use pounds if I may, as I'm in the UK, £1,000 worth of vegetables, and you sold them for £2,000. So straight away, you can see between those two that you made £1,000 surplus on your cash. You could refer to that as a profit as well for the time being. So you can see you bought them for 2,000 and you sold them for 1,000. So you made £1,000 surplus. It's perfect. However, you didn't sell them all. You had maybe 10 boxes of veg and fruit unsold. Okay, you got 10 boxes of the veg and the fruit unsold. Now that means then, in that instance, that's still, you've paid the cash for these, so this still belongs to you. That still belongs to you. So if I said to you as shopkeeper, okay, you need to pay your rent now. So here I come, I'm the landlord. I'm the landlord of your shop. And I said to you, hello, Mr. Shopkeeper. You're the shopkeeper. Hello, Mr. Shopkeeper. Can I please have the rent money? You owe me £100, please, for rent. And you say to the shopkeeper, right, I haven't got the cash now. So what I'm going to do, I am going to, and we call this realize. Realize, that means sell some fruit, some veg, because that will generate cash. Okay, that will generate cash. So you're going to realize, sell some veg and fruit to generate cash. And the problem is, of course, though, what if you can't sell it? What if people don't want to buy your veg and your fruit at the moment? That means then that the actual inventory that you have, we refer to there, your inventory of the veg and the fruit here at year end, your 10 boxes of fruit and veg unsold, you want to sell them quickly to generate cash. Why? Because you need the cash. So you are realizing your assets. That's what it means. Realizing your assets, selling your veg, get the money in, but they're not easy to sell quickly. In other words, your inventory is actually not very liquid. In other words, the fruit and veg you have at the end of the year left over, maybe 10 bananas, 10 oranges, you need to sell them quickly to generate some cash to pay the rent. But the problem is you can't sell them quickly. People aren't buying them. So you can't pay your rent. So that's what we mean by liquidity. So it's very difficult when it comes to selling the inventory to generate cash quickly for your shop. So when, for example, the ministry says we need to generate some cash quickly because we are not very liquid, that's what it refers to. Okay, you must have like money in the bank spare to make sure you got the cash you need to pay for things urgently, like paying salaries for all you good people who work in the ministry. So you need your salaries paid. So if the ministry says, uh-oh, we've got a problem, let's say on the 31st of July, the ministry has to pay salaries, as they will. Okay, what they've got to do then is ensure sufficient liquidity to generate cash to pay those salaries. Okay, so 31st of July, the ministry has to pay salaries. We know this. So they must ensure sufficient liquidity to generate cash to pay those salaries. because without the cash in the bank, the ministry is not liquid. Without the cash in the bank, your shop is not liquid. So it's very difficult to generate cash quickly, and that's really, really important why we need to budget. And that's why an important part of this 10-session course includes budgeting, so you can appreciate the importance of budgeting, especially in relation to be able to pay your bills. Have you got enough cash to pay your bills? Are you going to, ready, another word for you, liquidize your assets to generate cash? Liquidize your assets to generate cash. Remember, that means sell your veg to generate cash to pay the rent. But you knew when the rent was due at the month end. You knew the salaries are due at month end. So why didn't you plan for it? Okay. Why didn't you plan? And you know what? Ladies and gents, planning is all about budgeting. As simple as that. And that's the important thing in relation to the updated standard as to why we now include budgeting as well. And that's what Abby mentioned earlier on when she said 1/3 of this course involves budgeting. So you can see it's so important that when you're dealing with cash, you've got enough cash to pay your salaries. The company, the organization is liquid. There is sufficient liquidity to pay the salaries. There is sufficient liquidity to pay the rent. And that's what we mean by being liquid. Okay, so those short-term investments we mentioned earlier on, it's a situation where if you do have short-term investments like bonds, for example, so we use the analogy of the veg in the shop at year end, and you need to sell the veg quickly to generate cash. Okay, that was the analogy we used with the shopkeeper. Okay, so from that perspective then, looking at it from the ministry perspective, we can see the importance here. So let's say the ministry has some short-term investments. The ministry has some short-term investments. And let's say, for example, there were bonds, and a bond is quite simply just a certificate to say you've invested money in maybe another department or something like that. Nothing to do with James Bond, by the way, even though I do resemble James Bond, but it's another story. Now, bonds then, let's say the government is going to earn 3% on the bond. Okay, so imagine then that the Ministry of Somaliland buys a bond, let's say in Ethiopia, buys a bond in Ethiopia from the Ethiopian government. So in other words, the Ethiopian government needs some money. So they borrow money from Somaliland government and they call it a bond. And they say to them, if you lend us that money, we'll give you 3%. So the Somaliland government will be getting their money back later on, plus an additional 3%. And that's when the Somali government are going to say, we're happy to do that as long as it's low risk and it's liquid. Okay, same as your fruit and veg in your shop at year end. Can that bond be turned into cash very quickly? So if the Ethiopian government said, sorry, Somaliland government, we can't afford to pay you back, then the Ethiopian government could sell that bond and give the cash back to Somaliland government. Okay, very simple concept, But it's a bit like saying, look, here you've got the Somaliland government. They issue the bond. Ethiopian government. Remember, you're going to get 3% investment back, 3% back extra. But then Ethiopia said, look, we can't give you your money back yet. So they sell that to, let's say, UAE, United Arab Emirates. That means then that the UAE buys the bonds from Ethiopia. Ethiopia pays back the Somaliland government. And that's how all these investments work, the short-term investments all around the world, short-term investments like this, where you're actually investing in different countries because you might have some spare cash. So Somaliland might have had some spare cash. And they actually said, we won't just leave it in the bank. We'll leave some in the bank to keep us liquid, but we want to generate more money as well in the future. And that's where, again, assistance from third parties might be coming in. For example, where the UAE, who are the third party, so maybe they're offering assistance indirectly by buying that bond. And that's what we're talking about there, about third parties. So this was once part 2, remember. Now part 1. Okay, mandatory. So this is a good example of that all coming together for you to show you how it's all going to work. Okay, does that all make sense? I hope I haven't confused you too much. I'm trying to keep it nice and straightforward, but some of the words you need to get used to, because when you start dealing with the standard does use some of these technical words. Okay, so liquidity, really important you understand the concept that cash is really, really important to manage. You must remain liquid. And if you've got some spare money and you invest it, like in a bond, you've got to make sure that that money is reasonably safe, as much as it can be. You're going to get a return on that money, extra cash coming in. And it might be that you need some support from a third party, like the UAE, who would then maybe buy the bond from Ethiopian government, give you the money, so you've got the money back that you need. So that means you are maintaining your liquidity position. Any questions, anybody? Does that all make sense? Anything you're not quite sure about? Okay. If there's no hands up, we'll carry on. Okay, so we're talking here about these definitions under the IPSAS standard, the cash-based standard. And the important thing to remember here is, like we said, it's all about the cash. Cash coming in, cash going out. So we've got the cash, cash in hand, cash on deposit, we mentioned earlier. The cash basis, a basis of accounting that recognizes transactions only when cash is received or paid. Perfect. That's really, really handy. So we don't include money that we owe, and we don't include money that we're owed. So if, for example, the UAE said, yep, we'll pay you that money, but not until next year, we don't recognize it until we actually receive it. The cash basis is lovely and straightforward, really is. No problems at all. The accruals basis is a little bit more complicated. I'll explain more in a moment. But ultimately, what we're trying to do here is appreciate that we want to compare to other countries currently using the cash basis. That's why we must follow the standard. Okay. So the third blob down, we've mentioned this already, cash equivalents, short-term, highly liquid investments, readily convertible to cash. That was the bond I spoke about, where the Ethiopian government will say, yep, there's your money back, or your fruit and veg in the shop. Okay, sell the veg quickly to pay the rent. Remember, liquidity. Another term that's quite popular here, cash flows, inflows and outflows of cash. In other words, receipts and payments. So all the different types of income that you have are your inflows, and all the different types of expenditure that you have will be your outflows. So, for example, you might have the VAT and taxation, donations, for example, interest generated. all that comes down to the cash itself, cash inflows. Your salaries, your telephone, your rent, when they're all paid, will all be the cash outflow. So we're starting to build up here a nice picture. So as we move along all our course together, we can actually see how we're going to gain momentum and move from producing a set of accounts on the cash basis to ending up with the accruals basis and seeing that flow. Okay. Control of cash. Now, 1, 2, 3, 4, fifth one down. The entity can benefit from the use of cash in pursuit of its objectives. Huh? What does that mean? Let's have a look, shall we? So let's go to our scribble board. Okay, so cash for use to meet your objectives. Now, when we're talking about cash for use to meet your objectives, what we're really talking about here is, let's imagine that we are Oxfam. Okay, we've all heard of Oxfam. Oxfam, big charity. Okay, and the idea is Oxfam receive donations. Okay, and remember, this is a cash inflow. So Oxfam receive donations, a cash inflow. Oxfam doesn't receive any government grants. They might receive a bit of support here and there, but nothing major. I assume we've all heard of David Beckham, have we? David Beckham, the footballer. David Beckham, the footballer. David Beckham is a regular contributor to Oxfam, the charity. So, for example, he might give, for example, £1 million a year to Oxfam. Now, Oxfam as a charity, to meet their objectives, what is the Oxfam objectives? Well, what they do, they help people in need. They help people in need. So, for example, if you're in a war zone, or these days, of course, with COVID, and people might be homeless, and people might need, for example, tents. They might need medicine. So you can see the important thing here is that cash is generated here by donations from, say, David Beckham. And then to meet the objectives of Oxfam, Oxfam's objectives is to help people. So again, they would actually be the ones that go and buy the tents, the medicine, and then they will be delivered to the war zone. And again, it might be people having no houses, they've been bombed. It might be they've actually got no water. So again, they might set up wells and pipes and things for them to actually give them some water. Okay. So from that perspective, that's what we mean by cash for use to meet your objectives. Now you think about the Somaliland government. Somaliland government, your cash inflows, okay, we know are going to be, like we said, taxes, taxation, other forms of taxation. So this might be what we call direct taxation, where it comes from you and I paying our taxes on our salaries. And the VAT might be, for example, from people buying food in the shop, indirect taxation. So you're taxed when you buy the food, whereas the other form of taxation might be you're taxed based on your salary. Okay, whereas here might be tax on food, as an example. So you've got the different types of cash flows coming in here, and from that perspective, there might also be some grants. So, for example, the US Okay, they made a £20 million grant to Somaliland. So you can appreciate the bigger picture here with different grants coming in for specific projects. So this grant might come in, like we said, for a specific project. So this is where the cash outflows happen. Now, you know better than me what the Somali Ministry of Finance spends their money on, but ultimately this money here is there to basically help develop Somaliland. And it might be through building roads. It might be through building schools, so children get educated. It might be supporting you guys through, say, SIPFA and your PFM training. So there's a wide variety of issues that the money will be spent on, but ultimately it comes down to the objective of the organisation. So the important thing, whether it's cash or accruals, is understanding the objective of the organisation. What is the purpose of the Ministry of Finance in Somaliland? What is the purpose of the Ministry of Communication in Dubai? You know, what does that ministry do? What's its purpose? Where will the money come from? What will they spend the money on? And is it being met for the right requirements? That's the important thing. Is it being met to buy, for example, the Prime Minister of Somaliland a new house? Or is it being met to actually feed the poor people of Somaliland? So again, maybe a combination of factors. I won't get too political here, you never know, but just in case. Okay, so this is where you've got your cash inflows and your cash outflows. And remember, it's all about the objective. What is the objective of raising the inflows? Why are you raising the inflows through direct and indirect taxation? To help develop the country, building roads, building schools, educating people. That's the whole plan. That's the whole concept. So the whole standard says to us, make sure you follow the standard so you show the world what you've spent the money on. Has it met your objective? And this comes down to one word: accountability. Making sure that the Somaliland government and the Ministry of Finance, and it comes down to you as individuals, are accountable for the money you're spending. Is it meeting your objectives? Okay. Just to give you another example so you can understand what I mean by this, I'm based here in the UK and I have 3 children all at school. Now, when I say all at school, because of the COVID, the school finished slightly earlier. So now my children are at home and on school holidays. But ordinarily, they'd be at school for the whole year as normal until the holiday time. Now, I am a trustee of the school. So here we have the school. And I am a trustee. The actual name we use is governor. Okay, trustee of the school, a governor. So we've got, of course, the head teacher, the principal. And we've got the other teachers. Okay, and of course we've got the children. And the teachers educate the children. Simple as that. Now what happens, the UK government, they say to the school, okay, how many children do you have? Oh, we have 2, oh, no pound sign there, my apologies. We have, let's say, 200 children in our school. So the UK government say, okay, we will give you £3,000 per child. So the UK government gives the school £3,000 per child. So this becomes the school cash inflow. Okay, money received from the government. So we can see based on that, the money coming in, the school cash inflow. But of course, being a school, the cash outflow has got to be carefully controlled. Because otherwise they might run out of cash. And of course it comes down to liquidity again. So most importantly, this is where I get involved here as a trustee and the governor. And I come along to the school and I'll say to them, first of all, hello, 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 what's been going on here then? How much have you been spending? Okay, and we look at how much the school's been spending. So we're looking, remember, is to meet the objectives of the organisation. Objectives of the organisation. So the inflows must meet the objectives, which become the outflows. And that's what the cash movement is all about. The inflows coming in from the government, as we know, the £3,000 per child. There's your inflows, and there's your outflows. Now the question is, what would happen if we were going through the outflows and we looked at a report and we saw things like this? So this is the outflow report. And remember, we are looking at a school. So the kind of expenditure we'd expect to see will be things like teachers' salaries. We'd expect that, wouldn't we? Again, shout out the screen. What would we need? Books, stationery. Okay, so these are all in order to meet the objectives of the school. That's what you'd expect to see. But what if we also saw in here the principal's holiday fund? I think we'd agree the principal's holiday fund should not be as part of the school's objective. So this is where I come in as a governor. I want to make sure all this money has been spent properly and the school's got good value for money. For example, they're not overpaying, they're getting good prices. But of course, I'm also going to say, hang on, head teacher, principal, what's going on? The principal's holiday fund, you can't pay that. That's not part of the objectives. And this is where we go back to Oxfam. If you've been watching the news about Oxfam as a charity, remember we spoke about their objective, didn't we, in relation to making sure that people will be looked after with tents. Apparently, there were some senior people in Oxfam and they were spending money on things they shouldn't have been doing, like drink, drugs, and prostitution. Now, you've got to bear in mind, Oxfam is a charity receiving money from donations from David Beckham. But all of a sudden, if they start seeing money being spent on things they shouldn't be spent on, like drink, drugs, and prostitution, then clearly people will stop giving them money. So what Oxfam did, they moved outside their objectives. So the cash control was moved away from helping people with medicine and tents into drink, drugs, and prostitution for a very small percentage of people. You've got to remember that, not the whole of Oxfam. And this is the important thing. Yes, Abby, prayers time. Okay, so we come to a natural. It's now what?
Yes, 5:30. Sorry.
Yeah, that's okay. It's now 5:30. So, would you like to go and take your prayers? And while you're there, pop to the toilet and have a cup of tea. So, shall we meet back at 6 o'clock? Is that okay, Abby? Half an hour.
Sorry. Is that okay for everyone? Is that enough time? Hello?
Yep.
Yeah,
Yep.
30 minutes.
It's okay for me.
Yeah, it's good for everybody. Okay. So
Okay.
let's. Okay, so we'll meet back then at 6 o'clock.
Okay.
Yes, it's okay.
Okay, thank you. Enjoy your prayers.
All right.
All good?
Bye.
Well done.
Yeah.
Okay, Abby, I'm going to mute my microphone now. Abby, I'm going to go and get a cup of tea and I'll mute my microphone, okay?
바꿔 그래서 x. 뭐 하다는 거 아니.
How are you, Abby? We all back?
Yeah, I'm back.
Yeah, everyone okay?
The
Everyone back
rest.
here? Everyone, look at all the boys and girls are back for our class. Well done.
Are they?
Here we got there. Yeah, everyone's coming back. Well done, everybody.
So Sean, the prayer time for Somaliland is at 6:29 p.m. So we need to break up before that, I guess.
So we've got
for 10 to 15 minutes. So the next break will be in about 25 minutes.
Okay.
Yeah.
Right. So
I'll remind you, we'll break around 6:25.
Yeah. Okay.
And then resume at 6:25, 6:40.
Okay. Are we still finishing at 7, or are we going to carry on for the extra 20 minutes, or what?
How long do you have?
Well, if we're down for 3 hours and we've allowed sort of prayer timing built into that, as this is the first one, let's finish at say 7 normal time.
Yeah.
And then for the next one, we can do the plans differently with the prayer time, so we don't lose the 3 hours as much.
Yes.
Yeah. Okay. So we finish at 6:25 for prayers, and then come back after 10 minutes, and then carry on till 7, and then go from there, shall we?
Yeah.
As the first one. Okay. So we know exactly what the plan is for the future.
Yes, and we can discuss that later on.
Yeah.
If this is the right time for everyone.
Yeah.
Tuesdays 4 to 7.
Yeah. Yeah. So they finish work at 4, do they?
Do they? There's also an option we can do it twice a week if that's doable, or do you want it once every week?
Yeah, we could do it twice a week. It's not a problem.
Yeah.
As long as the students have, because if they're finishing work at 4 and then giving up 3 hours of time to study as well, would they want to do that twice a week? So, I mean, I don't mind doing it twice a week if the students are okay with that.
Yeah.
If you're okay with that.
Yeah, it's up to the students.
Yeah. Okay. Is there like a head student we need to speak to, or a head of department we need to liaise with, or?
I don't know. I can ask the students. I think it's quite flexible.
Okay.
It depends on the students, I guess.
Yeah.
Is that correct?
Okay.
Is Suad here? Suad? Suad here? No. she's here, but she might not be back yet.
Okay.
Hello. Abby.
Hi, Suad. How are you?
I'm fine. How are you?
Good. We're just discussing while we're waiting for the rest of the students to come back. Well, when's the best time to do the workshops? Is Tuesdays 4 to 7 the best time? And then we will take into consideration the prayer times and all?
Yeah. I think the break time is 6:15. I think.
Sorry?
Yeah, the break time. You mean the break time?
I can barely hear you.
Can you hear me now? Hello, Abby?
Yeah.
Can you hear me now?
Yeah, better.
Okay. Yeah, you mean the prayer time?
Yes.
Yeah, I think it's 6:15. So we need.
Today.
Yeah.
So it's not 6:15. It is 6:30.
6:30.
Yeah, 6:30. Yeah.
So we break at 6:25 and come back at 6:40 for today. But we're talking about for the next sessions, is Tuesdays 4 o'clock to 7 o'clock the most ideal time for everyone?
Ask them. Yeah.
Abby?
Yeah?
maybe ask everybody to type into the chat room, say either yes for Tuesday or no.
Yeah, that's another question. Can you see the chat icon in the icons in front of you? It's like a, you know what a chat looks like? It's like a balloon icon.
No, the chat balloon is not working.
Yeah, that's what we were trying to fix a while ago.
Yes, it is disabled by you.
Yeah,
by
I
that.
don't know why. Maybe for next time we would try another option. I think if it's linked to a channel, maybe that's why. But for the next meeting, we'll try to make it work. But we tried doing that this afternoon, but it didn't work. So can everybody just speak up, I guess, or is everyone okay with Tuesdays 4 o'clock to 7 o'clock, or do you want to do it twice a week, or you're fine with it being once a week?
Twice a week will be fine for me.
Once a week? That's Faisal?
Twice a week. Twice a week, yeah,
Twice
twice a week.
Twice a week.
Yes.
Okay. If we do it twice a week,
Yes.
what's the other day? Is a suggestion? Will it be Thursday or Friday?
I suggest we do it on Friday.
Maybe 2 days. Maybe 2 consecutive days. Is it okay for everybody?
I think Thursdays are much better.
Thursday, yeah, Thursdays, yeah. Yes, Thursdays. I agree. I agree.
Yeah? Twice a week?
Tuesday,
Is that
Thursday,
okay?
Thursday.
And Thursday, yeah, twice a week.
Tuesday and Thursday?
Yep, that would be
Yeah.
fine.
Also,
Will be
my
fine.
suggestion, twice a week.
Okay, it's better for be twice a week rather than once a week. Okay, Tuesday and Thursday. Is that okay, Sean?
Yes.
Tuesdays and
That's
Thursdays
fine with me,
same
yeah.
time?
Tuesday, Thursday, and that's going to be UK time 2 p.m. to 5 p.m.
5, yeah.
Yep, okay. Maybe what we could do is email maybe all the students, have it confirmed that everyone's in agreement with that, rather than just maybe a couple.
Yeah.
Could we do that so it's fair to everybody?
Yeah.
Yeah.
We can do that.
And then that can be then it's kind of we'll look through all the emails to see what everyone's agreed to.
Yes. I'll send
Okay,
everyone
that'd be
an
lovely.
email.
Okay then.
Okay, we can continue on.
So 6:25 with a break for prayers again.
Yes, I'll remind you again. Hold on, there's feedback. I'm trying to mute everyone. There you go.
Okay, everybody. So welcome back from your break and your prayers, and we're going to break at say 6:25 for you to have your prayers ready then. And one thing that, in case you didn't hear what Abby mentioned to all of you, was we said that it seems to be quite popular idea to have these classes twice a week, Tuesday and Thursday. So what we're going to ask you to do is liaise with Abby, probably by email, just to confirm that you can make Tuesdays and Thursdays so it's fair for everybody, rather than just a couple people saying Tuesday and Thursday. So if the majority want Tuesday and Thursday, we'll go with it. But if the majority just want Tuesday only or Thursday only, and then we'll play around with the dates as we go along. So would you please liaise with Abby, probably by email, I'd imagine is best, Abby, isn't it?
Yeah,
to get it in writing.
That's fine. Yeah.
Yeah, and then we can find out exactly the best way forward to give you the best time for the dates. We're very conscious, of course, that you're doing this after work. So you've had a long day work already, and appreciating that, when I teach evening students in the UK, we're going from 6 in the evening till 10 o'clock at night. So that's like for another 2 hours ahead for you. So I'm very conscious of the fact that don't want to make it too much for you. Okay, so just bear that in mind. Liaise with Abby, please, and we'll go from there. Now, do any of you know the Meghan Trainor song? It's all about the bass, no trouble. It's all about the bass, no trouble. if you're not, feel free to join in, sing with me. And what I want you to be aware of is all about the ROM, no trouble. It's all about the ROM, because this is what this is all about, producing these accounts. The risk of material misstatements in the financial statements. So if we can remember this is the key reason why we're following this IPSAS standard, all about the ROM, the risk of understatements, overstatements, and omissions. So just imagine the different types of income to the government. You've got your tax, like we mentioned, your direct taxation, and then you've got your indirect taxation, like, for example, VAT. But what about things like property tax? So imagine the property tax was missing from those accounts. That would have a massive implication on the overall surplus available to meet the objectives of the organization. So it's really, really important we appreciate that when we are working and producing these ROMs, even down to the bookkeeping behind the financial statements, is appreciating the bigger picture. If we get something wrong, if we miss something out, even down to a disclosure, like we said earlier on, so like the USA have made a donation or a grant to Somaliland, and we've actually now got to make sure we show the donation and also the details about where it came from. Imagine Coca-Cola made a donation of even the equivalent of £100,000 to the ministry, like David Beckham did to Oxfam, appreciating the bigger picture and how it impacts on those accounts. So imagine if that was missing. All about the ROM. So always remember this song. And when we're all online together, we'll all be singing this song. It's all about the ROM, no trouble. So that will help you understand it better. Okay. So for the one of the parts of this evening's session, once we understand the basics of the IPSAS and where it came from and how it got there and why we've got it and it's been updated, is to have a look at a little exercise: cash basis versus accruals basis. Now, I've been touching on this quite a bit, haven't I? Identifying what cash means and what I'm going to link it to the accruals now. Okay, so we'll go back to our share screen with my scribble pad, and then we'll do a little exercise together, and you can get your calculators out and join in. Okay, so let's have a look then. Let's go back to share the screen. Okay. Cash versus accruals. Now, oops, how did that happen? Hang on. Right, so what we're going to do then is do some basic information and then have a little exercise together just to have a go. So let's start with cash first of all, and this is what we said earlier on. So every organization has a 12-month period of account. So imagine then that you are, like we said, you're the shopkeeper and you sell fruit and vegetables. Okay, so you sell the fruit and veg. 12-month period of account. Now then, your period starts on the 1st of January 19 and goes to the 31st of December 19. So this is classed as your year end. Okay, so when you're doing your bookkeeping and working in the ministry, you're working to a period like this of 12 months. So from that perspective, then there has to be the income and the expenditure. Remember, we said the cash inflow and the cash outflow. Okay, cash inflow and cash outflow. So, all nice and simple. So when the shopkeeper sells the fruit and veg, the money comes in, and we record the expenditure and the money goes out. And at the end of the year, we add up all the income, we take away all the expenditure, and that will give us the leftover, a surplus of cash or a deficit of cash. So in other words, surplus, we've got some money left over, deficit, we're overdrawn. Okay, simple as that. Cash method accounting. Now, that's nice and straightforward. We know exactly when it's coming in. Now, one thing that the 2017 standard then wants you to do is move towards the accruals. Okay, so transition to the accruals concept. Okay. Now, the accruals concept says that you record the cash inflow, the same as cash, nothing changes, plus any money you are owed. Aha, see the difference? So you still record the cash inflow plus any money you are owed. That's a big difference. And so there's the income. And for the expenditure, you record the cash outflow as normal, plus any money, but this time you owe. Excuse me. Okay, so this is the difference between accruals and cash. You are still accounting for the cash, as we know, but in addition to that, you're also bringing in and including money that you are owed. And that's what the accruals concept is about. It basically says that if you do it this way, you're showing a better picture than just cash alone. Because ultimately, in any business, any organization, public sector or private sector, there will always be an element of money that you owe and always be an element of money that you're owed. So going back to our fruit and veg shop then, from that perspective, like we said, on the 1st of the 1st, 19, and the 31st of the 12th, 19 is the year end. Like we said, income, expenditure. So here's your cash inflows plus money that you're owed from, let's say, credit customers. Okay, you're owed from credit customers. So let's imagine then that you've received £1,000 in cash and you are owed £200 from a customer who bought the fruit and veg from you but said, oh, I haven't got any money on me today, can I pay you tomorrow? But that tomorrow falls into our year end, so they're going to pay you maybe on the 1st of the 1st 20. So even though the cash might come in on the 1st of the 1st 20, we actually are going to record we're owed the money in this period. And that's the big difference between cash and accruals. With the cash method, you'd record the cash in the next financial year. But in this time, we would actually account for it in relation to when it was due. So what we have a special name for this. The people that owe us money are called receivables. Receivables. Another name for them is debtors. Okay, so you're actually accounting for the cash you received as well as the people that owe you the money. And the same applies with the cash outflows here. Cash outflows. You've paid out, say, £600 plus you owe your suppliers money. for the fruit and veg. And you owe your money to these suppliers. Now remember, you may pay your suppliers up here. But that doesn't matter because we're recording the actual liability in the year to which it relates. So it's got a special name again, suppliers. We call these payables, also known as creditors. Okay, payables, also known as creditors. So new names for you here. So we're recording the liabilities here. So if we think about it now then, at year end, we actually had 1,200 of revenue. Notice the word I'm using, revenue. Revenue, both cash and credit. Okay. And also my outflows plus what I'm owed is referred to as my expenditure. So can you see I've got revenue and expenditure. So the difference between my revenue and expenditure is going to be either a profit or a loss. So there's my revenue, let's call that A. There's my expenditure, let's call that B. And the profit and loss is going to be C. And the idea behind it is the reason why I didn't call it a deficit or a surplus is because I'm not just using cash. I'm using other things as well, like people that I'm owed money to. And don't forget, it might also be that you owe telephone. Maybe you have a loan and you have to pay the loan interest. But remember, cash accounting, you only record it when you pay it. But accruals accounting, if you owe the loan interest for December 31st of December 19 here, you account for it in that year. And all this refers to something called the matching concept. The matching concept. You're matching the income with the expenditure in the year to which it relates. Okay, in the year to which it relates. And our year, for example, the 31st of December. So it doesn't matter when you actually paid the cash or when you received the cash, did it fall into the period between the 1st of here, 31st of December? That's the period we're looking at, the matching concept between the income and the expenditure. So we're matching the cash inflows and the cash outflows and the credit coming in and the money we owe those suppliers, all being matched in the same year. And that's why we lump all the income together and call it revenue. We match all the expenses together and call it expenditure. And ultimately, it's a profit or a loss, depending whether we've made more revenue or more expenditure. So the concept isn't rocket science. It's exactly the same as cash accounting, except you're now adding on things that you owe for at year end and things that you're owed. So that's got the benefit of actually increasing your revenue and increasing or decreasing your expenditure accordingly. Now, I'm sure you can appreciate there are lots of ways this can be manipulated, but ultimately, that's why, once again, at the moment, we've got the cash standard, but we could then move quite easily to the accruals standard. So it really will help you when we've learned this IPSAS cash standard well, to follow on to the accrual standard will be quite straightforward. Okay, does that all make sense? So that's part of this evening's session to help you understand the basics of introducing cash versus accruals. Okay, and we're now on 6:25, Abby. Yeah, well done, lovely. So do you want to break for your prayers now? And then we'll come back at 6:40 and we'll do an exercise where you can get your calculators out.
We have 6 minutes left. We'll continue.
Okay, thank you. Okay, Abby? You remind me of a pilot. Hello, good afternoon. This is your captain, Abby speaking. We'll be flying at 35,000 feet. And if you look to your left, you'll see Paris. And if you look to your right, you'll see Egypt. We are slightly off course.
I have no idea where that is.
Are those headsets comfortable?
Yeah, they're fine. You have to just adjust it. But it's better to hear, and the mic's better as well.
Oh, okay. You sound nice and clear.
Yes, that's the
Am
idea.
Am I clear without a headset?
Yeah, you're fine. Yeah, you're doing fine.
Excellent. So what I thought we'd do now then is do a class exercise, a nice simple cash flow exercise. And then that'll take us through to about just after 7 o'clock, just about 5 minutes after. And then we can then, if everyone agrees, you let me know for Thursday and we can go from there.
Yeah.
Are you okay for Thursday?
Yeah, I'm fine. Are you okay for Thursday? Are you okay for the twice a week?
Yeah, I'll just check with my wife to check the diary. Nothing else going on. So when she comes back to me, I'll confirm for definite. She runs the diary.
Okay, good.
Yeah.
At least there's somebody running the diary.
Where would we be without our women organisers, I say? What time are you picking your daughter up?
5:30, and I have a meeting at 5:15. I have another meeting.
Okay, you have time?
Yeah. So 5:15 is my next meeting.
Okay. How about you say to your husband, "Oi, get your bum downstairs. You go to the school and pick him up."
I wish he's still on another call. I can hear him from here. That's why I wear the headset.
Oh, I see.
I can hear his meeting because he doesn't use a headset.
That's probably why you got 2 meetings going on.
Yeah.
Everybody back?
Okay. So is everybody back? I got an email here from Agit Fata. Tuesday and Friday, because some of them have SIPFA classes Wednesdays and Thursdays.
Oh, I see. Okay. Would that be too much for them then, 4 nights a week?
Yeah, that might be too much. Maybe once a week then.
Yeah, because they got homework as well, maybe for the SIPFA course to study for.
Yeah.
Maybe leave it once a week then, so it's fair for everybody.
Yeah.
Just in case, because I remember when I was a student, if I was doing evening classes and trying to do study for work as well, it's quite a lot to do, and meet homework deadlines. It's quite a lot, isn't there?
Yeah, that's gonna be too much.
Yeah. Okay, we just go once a week then, every Tuesday.
Let's see. I'll do the emails across the board.
See what the majority say. I mean, if there's only 2 people that can't do it, then maybe the rest can. Maybe we'll be able to
I'm gonna cross-check with the SIPFAs list as well. Yeah.
Okie dokie.
Yeah.
Okay.
3 minutes past. Is everybody back?
Abby?
Yes?
I think, it's still, they are praying, the members they are praying. So will you please give us another 5 minutes?
Okay, another 5 minutes then. Yeah. Thanks, bud.
Okay, 5 more minutes. Where's your second meeting, Abby?
Just online again with our finance people.
Okay. And
it's
don't
fine.
forget throwing words like accruals and things like that.
No, we have an early morning meeting at 9 o'clock.
Oh.
Yeah, that's early for me.
Are you a night owl, are you?
Yeah.
Yeah, my wife's like that. In the morning, she's hopeless, but at 12 o'clock, she comes to life.
I know, me too.
I'm a complete opposite. In the morning, I'm getting up at 5 o'clock, bright as a button, but about 9 o'clock at night, I start getting very sleepy, and by 10 o'clock, I'm in bed.
I'm up till 12 o'clock, still partying.
What about your children? Are they the same as you or your husband?
No, they're the same as me.
Oh no.
No, but we're all the same. We all can stay
All
up
night
late.
owls, are you?
Yeah. So we're useless in the morning.
Are you always late for school?
Yes. And it's not their fault.
Yeah. It's funny you should say that because I was at school the other day and we had a lady from the Philippines and she was always late for school. And I said to her, I said, do you have a problem in the morning? You're not a morning person. She says, no, I'm not. She said, I'm always tired in the morning. I said, you go to bed late? She said, yeah, usually about midnight. So I thought you've just confirmed that now, actually, Abby, that maybe it's a cultural thing.
No, it's not.
Have you got all your family still in the Philippines?
Yes.
And do you sort of contact live online?
Yes, but not with Teams.
What do you use?
Messenger, I guess.
Okay.
Much easier.
Do you like Teams?
Yeah, no, I know it's fine. It's fine for meetings. How do you find it? Have you gotten
I think it's okay, but I think go to meetings and Zoom is easier to understand, and the numbers the buttons are on hand easier.
Yeah, and this one you can't really see all the picture
Yeah.
faces in the camera.
Yeah,
Not
that's
like
right.
Zoom.
Yeah.
Where you can see everyone.
I was teaching 26 students in Athens the other day, and I had all all their faces and stuff I could see. Some of them was a bit shy about the camera, but those I could see. But yeah, I prefer Zoom, I think, and the other one, GoToMeeting. That's a good one.
Yeah.
But I suppose it's what you get used to. So the more we use this, the more we get better with it.
Yeah, this is what's allowed for Tetra Tech.
Yeah.
Teams, and we're not allowed to use Zoom.
Okay. And what about the other part of their business, selling hair pieces? How's that going?
Still there. It's yeah, now people are coming in and out of the lobby, so I have to check.
Okay.
Yeah, we're all good. So for today, there's because you don't see the participants in your screen there. So there's 18 attendees, 20.
That's not bad.
20 actually.
20 out of 30?
20 out of 30, yeah.
Yeah, it's not too bad.
That's good.
Okay. So what I'll do, Ab, is I'll send you an email of this work we're doing on the screen, my scribble screen.
Yeah.
And I'll send that to you, and feel free to send that to the students by email if they want it.
Yeah. So you have two separate ones, the PowerPoint and the scribble screen?
Yeah.
Okay. Yeah.
Then that way we can actually reinforce the PowerPoint through the scribble screen.
Yeah. I'll see if I can, if we can have a Teams channel for all this. I'll think about it.
What does that mean?
There's going to be a channel just for the practical workshops, IPSAS training, that they can access through Teams.
Okay. Oh, this has been quite a good sort of pilot this evening to see how it's going to work, isn't it? How we move it forward.
Yeah. Now I think we can. That was another 5 minutes. Because some people, maybe it's the connection. They sort of fall out of the connection.
Hello.
Yeah. Are we ready?
I think we are all ready to start.
Okay. All right.
Okay. So can you all see the screen where it says class exercise? Can you see that?
Yeah, we can see.
Okay. Okay, I'll read it to you, and I am going to send this to Abby to send to you as an email, but I'll read it to you so you can understand what's going on. So it says, you have been appointed as head of department and you are planning the completion of the financial statements. Okay, so we're going to be using the cash basis. So we're going to have a look at completing like a small period of account. So we've got inflows and we've got outflows. So what inflows do we have? The first set of inflows, here's our income. We're expecting 1,000 in January, like pounds, whether you want dollars, whatever. 2,000 in February, 3,000 March, 4,000 April, and 5,000 in May. It's nice and simple. Then we go to the next level of inflow, and we've got, we're due to receive a government grant, a grant from Coca-Cola. It's very nice. In March for 1,500. So what we've now got are two lots of inflow. Now remember, we are using the cash system, so we plot these items in based on when we're going to receive the cash. So we can now open up our financial statement. And we identified our inflows. Remember, we had January, February, March, April, May, and total. Our inflows then, we said, is going to be our... Now, let's assume we have a shop. You're head of department in this new shop, this new company. So the inflows are going to be, as it said, we've got 1,000, remember, on a cash basis. 2,000, 3,000, 4,000, 5,000. So we can say, okay, based on that, we've got 5 and 4 is 9, 10, 11, 12, 13, 14, 15,000 worth of income. But the important thing is, that's the total, and it shows no receivables. It's purely on cash. Now the next inflow, so this can be, for example, sales. The next inflow was that grant from Coca-Cola, and that's due in March. That's nice and easy. So we can see then our total inflows. Total inflows, we've got 1,000, 2,000, 4,500, 4,000, and 5,000. And that should equal 16,500. Okay. So please have a go at home where you're sitting. Join in with me, please. Join in. Have a go as an exercise. So the inflows based on a cash basis as per the IPSAS, exactly when you receive them. Then we have the outflows. Okay, there's our inflows, there's our outflows. Now then, what outflows do we have? Let's have a look. We are told the outflows here, oops, you've got salaries are 6,000 per month. Okay, salaries are 6,000 per month. Right, that's quite easy because again, it's cash based. So the salaries as an outflow are 6,000 per month. Again, join in with me. And we've got 1, 2, 3, 4, 5, 6 fives, that's 30,000. Whoops, already overdrawn by lots of things. Okay. Now then, we go back to the question, the information, it says, so that's that one. You pay the tax on your salaries in the following month. So let's say the tax on that salary is 500 a month. You pay the tax on your salaries in the following month. Now then. So the tax on the salaries, so you're now looking at this from another perspective, because don't forget, in the government accounts, this would be income to you, wouldn't it? So the salary for January, as it's cash, the tax is going to be February. The salary in February, the tax is going to be paid in March. Remember, based on cash flow. The salary in March will be paid in April. The salary in April will be paid in May. That's great, but hold on a minute. What about the tax for January? Well, that's paid in February. So do we need a figure to go here? What figure will go there for what month? Can anybody tell me? Can anybody tell me what figure is going to go there? Just unmute your mic and shout out. What amount is it going to be and for what month? So assuming 500 again, but this time it would have been for anybody?
I think December from the last period.
Well done. Good answer. Well done. Fantastic. Good thinking, you see. Because with cash, you're quite right. We've got to bring forward the December salary tax, haven't we? So well done. Who was that? Who gave me the answer?
That's Adam.
Adam, well done. Good work. Thank you for contributing. Well done. You get 5 bonus marks. Okay. So your December one will be 500. So you still got then 5, 10, 15, 20, 25,000. So again, 25. So there's the 30,000 there. Just tidy that up. There's the 30,000. And we said the 5, 10, 15, 20, 2,500 there on the tax. That's all nice and tidy. Good. Yep. So well done, Adam. That's good work. Then we go back to our information and it says you pay your telephone costs at the end of each quarter. Now, remember, a quarter is every 3 months. So let's imagine then that we're going to spend £30 or $30 every 3 months, okay, at the end of each quarter. Now, remember, cash flow, it's got to be when we pay the bill. So we go back and we say, okay, telephone. So we've got January, February, and March as our 3rd quarter. So we're now paying £30 at the end, but just double check. So it's £30 a quarter, so it's £10 a month, our telephone. And again, end of April, end of May. So in actual fact, we're only doing up until May. So as far as June's concerned, we're doing nothing with it. So June won't go in. So the only telephone we're going to show is 30. Just pause there for the moment and look at what we're doing. We're only showing 1 quarter's worth of telephone based on cash. If we were using the accruals, we'd be showing 60, wouldn't we? Because we owed for the April, May. Actually, we'd be owing the another 20, wouldn't we? £10 a month. Okay. Does that make sense, everybody? Everyone okay with that? So therefore, we've now paid the telephone bill and we've done that. And then it says there's £100 to bring forward on the 1st of the month. So what is the closing cash flow position at the end of May? Okay. So what we're now going to do is add total cash outflows for each month. Remember, we've got here, so there's the inflows. So the outflows for January are 6,005. We've got another 6,005 there for February. We've got 6,005 plus the telephone there, so 6,530. We've got another 6,500. And we've got another 6,500. Okay, total cash flows. Now then, we've got our inflows here. These are our cash outflows. What we now need to do is work out the difference between the two. So then we're going to have something called net, which is the difference, net cash flow. So it's going to be then the difference between the inflow and the outflow. So again, please work away at home, work on these figures. So we've got 1,000 of inflow, 6,005 of outflow. So that's going to leave us 5,005. Now, don't forget, the situation is this. We've actually got more outflow than inflow. So that now goes in brackets, okay? So it's like an overdraft. We're overdrawn more there. What have we got here? 6,005 and 2,000. So now we're 4,005. But unfortunately, we still got more outflow than inflow, overdrawn again. This time it gets a bit better. So you've now got your 6,530. That's a little bit better. And we've got 4,500 of inflow. So now we're looking at 2,030. Unfortunately, still an outflow, but it's getting lower, isn't it? It's coming down a bit. That's good. For April, right, we've got 4,005 of outflow and 4,000 of inflow. So it's getting a little bit better, marginally. And then we've got for May, 6,005 of outflow and 5,000 of inflow. So there's going to be 1,005. So we identified the cash inflows. We identified the cash outflows. We then identified the net cash flow. Remember, using the IPSAS, okay? IPSAS. Now, the next thing to do is to bring forward anything from last period. So we're bringing forward on the 1st of the 1st, 19. How much are we told? There's £100 to bring forward on that date. So we're bringing forward £100 positive. That's lucky. So that means then we're going to carry forward. Now at the end of January then, we're carrying forward 5,400. But remember, it's an overdraft. Now, watch this carefully. The carry forward here becomes the brought forward here. So we're now bringing forward from January 5,400, which means, 9,900 overdrawn. You see how that worked? We identified the inflows, we identified the outflows, we identified the net cash flow. We're actually bringing a positive cash flow forward, but due to the poor income inflows, obviously we're now quite overdrawn here. So once again, 99 in February comes forward. Oh dear, that's a shame. So we got the 2030 and 9900, so 11930. So our overdraft is getting bigger. So we now bring forward, again, join in at home, do this with me, 11930. So we've now got 11930 and the overdraft of 2005 already. So now we're looking at 14430. Remember, overdrawn. That comes forward to here. 14,430. And of course, we've still got a 1,500. So we're going to finish the end of May, 15,930 overdrawn. And the question says, what is the closing cash flow position at the end of May? So the 15,930 is our closing cash flow position. So clearly we can see from a cash flow perspective in the bank, we're going to be overdrawn. So we need to start making plans to get some money back in quickly. Otherwise, we can't meet our objectives. Like in the ministry, you can't pay your defence, you can't pay salaries, can't pay for cleaning and rubbish and police and everything. Does all that make sense, everybody? Does it all make sense? So because we're following the IPSAS standard of cash accounting, we're only recognising the cash when it goes in or when it goes out. And some of the issues here were based on the fact of when did the grant come in? When did we pay the telephone? When did we pay the tax on the salaries? So that has an impact on our monthly cash flow. Okay. Now, what we did there, without you realising it, we actually produced a cash flow forecast. And a cash flow forecast is a form of budgeting. So basically, you are budgeting for cash. And at the end of that period there, if I was your manager, I would say to you, okay, Adam, how much are we going to need at the end of May? And you'd say to me, we need about £16,000 to make sure all the bills are covered. Does that all make sense, everybody? Yeah? Is that okay? Right, so let me just click back on that. Okay, so that concludes our session for today. We've covered everything we wanted to do in terms of the overview, the definitions, and understanding the implications on the cash flow. Does anybody have any questions at all, please? Is everybody happy? Everyone okay? Any questions at all? Anything you need to ask me? So what we'll do then, I'll leave it with Abby to liaise with you about the next step, whether we're going to do Tuesday and Thursday or Tuesday only, and it will depend on what the majority want. We appreciate some of you are doing SIPFA, and you might be a bit tired if you're doing it a few days a week as well. So Abby will liaise with you on email and let me know. So I'll either see you on Thursday or Friday, I think Abby said, didn't you, Abby? On Friday? Yeah. Otherwise, I'll see you next Tuesday, but Abby will let me know.
Yeah.
Okay, thank you everybody for joining us today. It's been a lovely class being with you. As we go along, don't be afraid to open up, talk to me and share your experiences, and we'll move along and have a bit of fun. Okay, thank you everybody. Thanks for coming along.
All
Give us a big wave. Bye, Kadir, give us a wave.
Thank you.
Oh.
Thank you.
Thanks, Sean.
Okay, thank you everybody. See you all soon. And yeah, have a nice evening.
Adam has a question, I think.
Abby, yes, yeah.
Oh.
Can you hear me?
Yes. Yeah.
We were discussing the next time or next classes, and so
Yes.
the participants, some of the participants, they are taking their SIPO classes, and some others they are in the domestic revenue mobilization courses. So the only time that is vacant is the only Monday. So will you remind please if we can make it on Saturdays? What about your side on Saturday?
No, we can't do Saturdays.
And so we will continue later, but the only time that they agreed on is Monday. And because
we
Tuesday,
can make one is a week, and that day will...
Yeah, perhaps once a week, and that's Tuesday.
And
Does
Monday.
this work?
And Monday.
Only Monday.
Yeah.
Sorry? Sorry,
And
Faisal was talking, and Suad is talking. Sorry, one by one, please. Sorry, Suad?
Yeah, the members agree that only Monday is the only time that they can have a free time. Take part.
Oh, Monday. So not
Yeah.
Tuesday. You don't prefer
Not
Tuesday?
Monday.
So no Tuesday.
No Tuesday, yeah.
No,
Monday.
we can just do once a week
Okay.
for Monday.
Yeah, nice.
Is that what everyone agrees?
Yeah, majority of them, because
Yeah.
the other time we have other classes.
Good,
Yeah.
good.
Yes,
Alright.
yes, we agree on Monday only.
Okay,
yeah.
Monday once a week,
Yes,
same
yes.
time, 4 to 7. Yeah?
Yeah, normal. Yeah.
Yeah.
Yeah. And then how do we know
That
what
would be
time are the
all right.
breaks for the prayers? You let us know at the start?
And I will combine the break time.
Yeah?
The prayer time is 6:30.
6:30.
Yeah.
Okay, so maybe 6:30 is a better time to break.
Yes.
What we can
Yes,
have
I agree.
2
I
hours
agree.
straight, then we take a break at 6:30. We pray. Then after that we can wind up for 20 minutes.
Yes, yes. We can probably finish by 7:15 if that's okay.
Yeah.
Yeah?
All right. That would be fine. Yeah.
Yeah, so it's gonna be 4 to 7, break at
Yeah.
6:30,
Uh-huh.
and finish at 7:15. Is that too much?
Yes. No,
Yeah.
that would be very
Yeah.
fine.
But how was everything today? Were you able to hear everything clearly? Did you understand everything?
Yeah,
we hear
it was
you.
clear and to the point.
That's good. And you were able
But
to
we
do the
request,
exercise.
the recording of this session to be available to us on a link. Maybe
Yes,
on
yes.
this Microsoft Teams, so that we
Yes.
can, make a recap and then,
Okay. Yeah, we'll do that. And
Yeah,
and everything,
that
Sean will be
will
sending me
be
the
better.
PowerPoint. Sorry? Go ahead.
Let us have this record, please. Yeah, that's better.
Yes. Yeah, and the PowerPoint and the scribble. I don't know what it's
Thank you,
called.
Abby, and
Yes.
thank you every one of the participants.
Yeah. And it
And
would be good
I
if
hope we can.
yeah. Go ahead.
Abby, we
Yeah.
also need to chat box.
Yes, the chat box. We'll set that up next week.
Yeah, thank
The next session. So next session is on Monday. So we'll have the chat box available. Are you not comfortable with having your cameras on? Because I think
Me?
Sean likes to have the cameras on.
Yeah,
It's
but I was
okay. It's okay.
It's fine.
Don't you shy?
No, it's fine.
Just
It's
kidding.
fine, but it was disallowed then. Allowing it was a little bit problematic at the beginning, but now I think in the next session maybe we shall be able to say hi to each other.
Yes.
That'd be nice. Yeah, that'd be lovely.
That would be nice.
All right.
And don't forget, your homework is to practice that song.
Oh, it was.
I'll send that video on a link as well. Just kidding.
All right. Thank you, guys.
Okay, well done, everybody. Thank you for attending.
Okay.
I've enjoyed being with you. Thank you. See you on Monday.
See you Monday.
Okay.
Thank you, Mr. Sean.
You're very
Okay.
welcome.
Bye bye.
Okay. Bye, everybody.
Bye.
Bye-bye.